Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most? And do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
All right, welcome to The Wealth Flow. My guest today is Sam Zoldock. Sam is a commercial real estate broker based out of Birmingham, Alabama, and has a focus in the industrial space, but I know he's done a lot of other stuff as well. And Sam, welcome to The Wealth Flow. Can't wait to dive into your story here today.
Yeah, Keith, thanks for having me. Excited to be on today.
Yeah. And if we could maybe start with kind of where you grew up and what eventually led you to real estate investing.
Yeah, I grew up, I feel like the epitome of the Rich Dad, Poor Dad podcast book. Grew up in Atlanta, Georgia, grew up in a single family home, just me and my mom. And, really just grew up, my mom kind of flipped houses as we got older and to learn real estate that way. But really we would just drive around and she'd be like, hey, what would work there? And we'd, drive past, a super busy intersection. I'd be like, man, there should be a Chick-fil-A there. And then a couple of years later, like Chick-fil-A would be there. And I was like, wow, you're pretty good at that. And I was like, I guess. And I just kind of had a natural sense for where things should go. Always have loved to build things, grew up building things in the woods in the backyard, and kind of fell in love with real estate really because of the people. If you had told me in college or in high school, like, hey, you're the kid that talks all the time, you can get paid to talk to random strangers all the time and it'll make you money. It'll be like, yeah, that's the job I want. Why doesn't anybody tell high school kids that talk a lot like that a sales job is coming their way? and really fell into it because the people who I wanted to be like were in real estate, were in private equity. They were the most generous. They spent the most time with their families. They had great family lifestyles. And so I was like, this is kind of the path that I want to go down.
Okay. Yeah, that's kind of neat. It's neat that your mom was into flipping houses and stuff as well. That's kind of a cool background to have, and just being able to see. Did she flip quite a few? Tell me, I guess maybe a little bit about what kind of impression that left on you.
Yeah, we were the folks that flipped the wrong way, I would say. My mom would buy a house and we'd live in the basement, and she'd be redoing the kitchen, and all of our meals either were on the grill or on the microwave. It wasn't, all my friends were like, where's the furniture in your house? Like, oh, we don't really have furniture. Like, we're going to be out of this house in a little bit. We'd always buy a house in Atlanta specifically. Kind of the value add strategy, I guess, is buy a house in the path of progress that has an unfinished basement, and then finish the basement. And that adds to the square footage of the house. And that's kind of like your upside. And so we did that a handful of times. My mom bought a house the year I was born. And the year I graduated high school, she bought a house in the same neighborhood. And both times when she sold those houses, she doubled her money. So I was nice. Wow. In Atlanta, the joke is houses never appreciate because, you just go down the road. There's so much flat land that you can just go down the road a little bit and the next track builder's building more homes. But if you can find the right neighborhoods in Atlanta, you can really make a ton of money, flipping houses. And she had no machine by any means. I just was always, I always knew that you had to be a really strong communicator and you really had to press your thumb down on the contractors doing the work, or else they would take advantage of you. I'd watch these guys come in, work on the bathroom, and it'd be halfway done, and then they wouldn't show back up for a month. And so I thought, flipping was like the most horrendous thing in the world. Then I kind of realized like, oh, you just need to be like really, really type A. And really aggressive, and make sure you don't pay them before they do the work, and then they'll show up on time.
Right. Exactly. And so then as far as your real estate, how'd you go from that to, kind of getting into the industry yourself?
Yeah. Getting into the commercial real estate industry, I think, is the hardest part about the real estate industry. So many people, when they graduate college, there's all these like real estate major, right? Or whatever. And maybe for the more seasoned folks, it's like impossible to get into. They feel like it's impossible to get into real estate. I would say the first thing I did is I pursued a mentor, just trying to figure out who in the business can I like go and talk to about this, right? Who will like go to lunch with me every couple of weeks and tell me about the deals that they're working on and show it, kind of let the ladder down for me. And the first guy I worked for, we did a bunch, not directly in the commercial real estate space. We were more private equity based, family office kind of style, but he had a portfolio of luxury rentals and some real estate development stuff going on. And so I kind of got to dabble in that a little bit. But really what propelled it is that mentor of mine from college eventually said, "Hey, why don't you come work for me?" And he kind of handed me a phone and gave me a desk, and that was my opportunity. And from there, it really has flourished into, hearing no. In the first 24 months, we looked at 3,000 investment opportunities. We underwrote about 500 of those. We offered on about less than 100, and we bought one.
Oh, wow.
And so you learn what you're looking for, not by hearing yes, you learn by hearing no. And so there's a lot of deals out there that people are losing their tails on. And, you and I both know, we look out there, the syndicator rise of 2021, 2022, 2023. And now if you go on Twitter, everything is essentially, this deal is falling apart. It's exposing, people who weren't really making distributions, or deals that are, weren't sold as advertised, and learning to just navigate through that. It's a lot harder than just like, hey, this is posted on Crexy and, hey, we can go buy this deal, or call this broker. He'll send you a deal and you should buy it. Right.
Yeah.
I learned to cut my teeth on, what we look at. Some things that are important to us are like replacement cost, replacement rent. And really, you kind of can't get past like the location. Like, is dirt, is this the highest and best use of this dirt? Then if it's not, what can it be? And can we buy it right to make sure that we can replace it going forward? Because you can buy the best dirt in the city, right? But there's a finite number of what somebody can pay to build it there. Like, you can't just go spend $20 million in Birmingham on a corner site because you think it's a good idea. You need to actually know how to underwrite that site. And that's essentially how I cut my teeth in the industry. And that was the slingshot that propelled me forward, is really hearing no about 2,500 times.
Yeah. What kind of deals were you evaluating and calling on? I know you've done, some industrial. What did you initially start with? Was that industrial as well?
Yeah, so our fund that I currently work with is asset type agnostic, but locationally specific. So we only invest in Alabama,
Okay.
and we'll look at all asset types. When I say all asset types, the original kind of core, so industrial, office, medical, retail. We don't really like stray from those.
Okay.
We don't invest in multi. We don't invest in self storage. We don't invest in hospitality assets. So, but even those kind of core asset groups, retail in itself is a whole knowledge base. Industrial in itself is a whole knowledge base. Office in itself is a whole office knowledge base, and then medical in itself is a whole knowledge base. And so, when I kind of sat down, when he handed me the phone, he was like, "Well, what do you want to call it?" And I was like, "I don't know what's going to make me money. Like, all right, like I need to be here. Like I need to close the deal to be here." And he was like, "Oh, don't think about it that way. Like, think about like what's going to be the best investment for our investors." And so we're very thesis based. And so I kind of had to go right and defend why we were investing and what we were investing. And really, we focused on medical office and industrial, kind of exclusively over the past 4 years, really with a strong focus on industrial.
Okay. And tell me a little bit about Birmingham and are you in just kind of the downtown area of Birmingham or all around?
Yeah, Alabama is really small.
Right.
There's more industrial in one corridor of Atlanta than there is in our entire state.
Right.
And that might be a little bit of an exaggeration, but when you can identify all the properties in your market and someone throws out an address and you're like, I'm familiar with that address. You just don't get that in other towns, right?
Yeah.
And so, our big markets here in Alabama are Huntsville, Birmingham, and you've kind of got this like I-85 corridor is what we call it. So that's like the Montgomery, Auburn area. And then you've got the Baldwin County and the Mobile County. So Mobile, Fairhope kind of area. Those are your big hot spots.
Mm-hmm.
We a lot of time, just because of the nature of our third party services business, the management, the brokerage, all of that, in Birmingham and in Huntsville, where we have offices.
Okay.
And those two cities are amazing because they don't get really hit by recessions. The main thing that hits Huntsville is government contracts come and go. But Birmingham is just kind of maintained. We haven't grown. We haven't gone down in size. The outskirts have definitely grown population-wise. But Birmingham is also geographically challenged with the terrain, and kind of the just outer skirts of town is not like necessarily the easiest to develop, and the city's kind of hard to deal with when it comes to new development. And so and when I say hard to deal with, it just takes time, just like any other municipality out there. And they go through ebbs and flows of, hey, we want new development. Hey, we don't want new development. There's not a mindset of not wanting to grow, but people like small town, big city feel here. So the Huntsville folks, if you go to Huntsville, it's not really like Alabama anymore, in my opinion. It's a mix of northern blend and southern, and it's a bunch of engineers, right? It's
for sure
some of the people you'll know in the country. It's got more PhDs per capita than anywhere else. So you've got like a very unique culture up there. And then the rest of the state really operates on kind of a good old boy market. So it's a lot of handshakes, a lot of family businesses, things like that. Something interesting about the Birmingham market is why we really care about replacement rents, replacement costs, things like that, is you basically had flat industrial rents in the city for almost 20 years.
Really?
So the late 90s to the 2020 era, you essentially had flat rent. It was $7 triple net rent if it was good new product. And if it wasn't, it was less than that. And then with the rest of I think the rest of the world would say, oh, our market, industrial rents grew, or our market, industrial was one of the top performing assets. Like for Birmingham, really in the last, I would say 5 to 7 years, industrial has taken off as one of the top investments because the rents have grown so much in the past, 36 to, 84 months.
What do you think's driving that? Just the increase. I mean, I know a lot of places, it is, and it's also becoming a fairly hot asset class. It seems to be very popular. A lot of folks kind of stepping out of some multifamily with that getting, the cap rates getting suppressed and going into spots, and one of those being industrial. But what is driving the increase? Is the population changing much in Birmingham right now, or?
I would say so. Little history lesson. If you follow GE, right, for the last 50 years, they were basically like the great consolidator, right? They wanted to be vertically integrated, probably coming out of, the 70s and the 80s up until very, very recently. I would say really till COVID, you have what I would call the great consolidation. Businesses want to be fully vertically integrated. If you made hats, you wanted to make the logo, you wanted to make the thread, you wanted to manufacture every part on that hat, the plastic part on the back. And that goes down all the way to houses, right? If you wanted to build houses, you had your own land brokerage, you had your own concrete company, you had your own site development company, you had your own framers, you had your own plumber, you had your own HVAC guy, all the way vertically integrated to, land sales on the front to selling houses on the back of it. And I think in COVID, and really kind of before COVID, GE started to sell off. I use GE as a great example. It's because they were acquiring and then they started to sell off all their parts, and it was like a shock to the private investment world. And you really see that now where in a post-COVID world, people are like, man, I can work for the same company, but I can work on a contract basis. I can set my own hours. I can work half as much and make the exact amount of money I was making beforehand. I can also go to another company since I'm working half as much and pick up their business. Yeah. And now I make double. And so I would say we're in this phase of what I would call the great deconsolidation of the rise of the small business entrepreneur, the rise of, the 1 to 5 person company. And I think those are kind of here to stay, right? Where as taxation goes up, people are looking for, tax relief. And one of the ways to do that is be in a small business, not because you do anything sketchy. That's just how the tax code is written from hundreds of years ago. And so, not hundreds of years ago, but you get what I'm saying. And so in my opinion, Birmingham has a lot of older industrial buildings. Mm-hmm. And Birmingham at one time was one of the top banking cities. It was up there with the Charlottes and the Pittsburghs and things like that. And then kind of fell off. And so there's a lot of smaller industrial based buildings that have been occupied. And when there's a grow in supply from the great deconsolidation, from the rise in small businesses, that's just going to push your rents up. And so where we were seeing, $4, $5, $6 triple net rents, now we're seeing $7, $8, $9 triple net rents. And that can make an absolute killer difference in what building and your appreciation in property and all that.
Yeah, for sure. Yeah, it's a neat downtown for sure. And then Huntsville, that has just grown and grown. Part of my W-2 is that I travel to Huntsville. I mainly just fly into Birmingham if I'm going to be going to like Sylacauga and some other locations that we have. But Huntsville has changed over the last 13 years dramatically. I can just the downtown is just awesome, and it's really seems to be a very cool city. And Birmingham seems like it's got like this history of the past, especially in the downtown, that I really like. There's a hotel that I'll stay at sometimes there. It's a Marriott branded. I don't know that it's not Marriott, but it's like a Fairfield, and I think they've got I forget what the other one is next to it. But my understanding is one of those buildings was like considered to be one of the heaviest buildings with all the marble and granite and everything. They got a really cool bar at the very top of it as well that kind of overlooks the city. I'm not sure if you're familiar with it, but anyway, really cool downtown. So I see there's a lot of potential there, but it doesn't seem like it's got the same kind of growth that you see like in the Huntsvilles.
Yeah, Huntsville and Birmingham grow differently.
Yeah.
So Huntsville, there's just so many opportunities for it to grow because everything around it is flat, essentially, right?
Yeah.
So like Madison, a submarket in Huntsville, another city just outside of it, has just exploded because it's like, oh, we can build a Publix and retail center, and we can build a movie theater and this, and we can build a power center here, and we can do, we can just keep going because there's so much highway frontage and road frontage. And then, it's like, we'll build apartments, and then we'll build houses, and then we'll build like luxury houses behind it. And then down the road, we'll build a warehouse so all these people can go to work. And then we'll make sure that it's connected to Redstone Arsenal so that, people can easily get to the base back and forth. It's like really easy growth plan. Like whoever has the economic development job up there or the, city planner job is just like, go down the road, new pre-planned community.
There you go.
Birmingham has a lot of history. The same guy that designed Central Park designed a city called Fairfield. Fairfield's 15 minutes from downtown. Fairfield's one of the top 3 poorest communities in the United States. And when you look at that city, that used to be like the high-end part of Birmingham. And then, through an unfortunate series of events, people started to move, and you have cities like Mountain Brook or Vestavia now, which are some of the highest end communities in the country. They were built, kind of on the backs of some really racist ideas that certain races couldn't own homes in these areas, or, only certain groups could own homes here. And so you had like kind of the New York style, like this is the Italian area, and this is the Latino area, and this is where where all the, this is the Scottish area, and this is the Irish area, this is where all these people can live. You start to see, when you start to look at Birmingham's history through that lens, you're like, wow.
Yeah.
And Birmingham changing now. It's one big melting pot. But there is like a big mountain down the middle of Birmingham that divides kind of the urban, more, unfortunately poor, just quite frankly, areas, some of the more affluent, wealthier areas. And we call it, when I do a lot of work in the urban areas through urban missions kind of stuff. And we call it like the over the mountain money, or the Great White Hope, which is going to come in and save. And I think every city kind of has that. It's like, here's your pocket of wealth, and they feel guilty that they have so much, so they want to give it to the kind of the poorer poverty area. And what's really interesting about Birmingham is it's not growing east or west. It's not growing north. It's really all growing south. And it just continues to follow the I-65 corridor. And that a lot of that is the I-65 corridor has more of the buildable terrain. North Birmingham doesn't have as much it's just crazy to think about, like when you and I think about the earth, or we think about America, right? Like, think like, you look at a map, you're like, look at all this land, right? Like, we have so much room to expand. That's what I think is a real estate investor, when you think, oh, okay, like I look at this, all this land. And then you start to realize, and that's a really unfortunate part that kills lots of people's real estate dreams, is you can't build there, you can't build there, you can't build there, there. And that's like Birmingham for you. Like if you want to get your teeth kicked in on a development deal, like come to Birmingham, Alabama, because it is so hard. It's like, oh, that site should work. Oh, that site's on a mountain. Oh, that site should work. Oh, there's an underground, old mine or something on it. Oh, this site should work. Oh, that's contaminated. Oh, this site should work. There's a number of laundry lists of reasons why it doesn't work. And when interest rates were low, developers came and took the risk. Huntsville doesn't have a lot of that. Huntsville is like, this site, you can build anything you want on it. And the city is pro growth. They want to grow. They're pushing things through fast. We've got some great people on city council up there, got a great mayor in Huntsville. And so it really is just wild when it's like, when you got good dirt and good people in place, your city can grow massively.
Yeah, for sure. Well, tell us a little bit about some of the types of real estate deals that you're helping your clients with, but also just helping investors with as well.
Yeah, my favorite deal to do, Keith, is an industrial value add deal, and so what that looks like is I've kind of got three things that I've adopted from mentors. That a great deal has a short time frame, something wrong with the property, and a motivated seller. And that's what I typically look for. So my deals typically have a lot of hair on them. Every deal has a title issue, essentially, which is like red tape for most people. They're like, oh no, the title company is going to have to do some work and earn their fee. Like, oh God.
Right.
I think about one deal where we found this warehouse and the buyer, my client, had to hire an attorney who then went and found that the two owners ago had misrepresented that he was the owner of the property and sold the property illegally. So he had to go get the original title from that property, and that guy was in jail. So the attorney had to drive up to out of state to go get the title. Well, he was like, I don't have the title. It's in my old mobile home. So he had to go get the police, clear out the mobile home, and the title, thank God, was actually in the filing cabinet that he said it was in. Bring it back to the jail, have him sign it, come back down to Birmingham, get the now owner to sign off on it, and then get my client to sign it. And that was just to get clear title to the building.
Wow.
And when I tell you, you want to guess how much that building cost?
Yeah, I have no idea since I don't know too much about what it.
Yeah. So that building was $100,000.
Oh, wow.
And my client put 100 into it and sold it for about, $500,000. So
wow.
He was able to make a pretty solid return on his investment. And when you think about it like that, you're like, man, most people are like, man, I could double my money. Like I can, he's an all cash kind of guy. That's just how he likes to do it. But it's like, when you think about that, there's a lot of ways to get a 2x equity multiple, probably like what you're familiar with when we look at multifamily deals, right?
Mm-hmm.
Every indicator ever is like, I've got a 1.9 to 2.1 equity multiple over a 5-year hold. I was like, this guy did it in 12 months.
Yeah.
And that's pretty incredible. And there's still a lot of meat on that bone for that deal. He only sold it at $50 a square foot, and it probably is worth $75 a square foot. So the next guy even has opportunity to go make money on it. So that deal's kind of interesting. But anywhere that we can buy, what we look for are kind of down the fairway deal is, how can we find a warehouse between 5 to 50,000 square feet that's got roll-up doors that are dock high, drive-up doors. It's got 18 to 32 foot high clear height ceilings and a little bit of office, mostly warehouse. How can we slap some lipstick on it, paint it, fix the kind of fix the parking around the property, new asphalt, things like that. update the office. Most of the office in this industrial stuff is 1970s built out, original kind of, moldy, just ugly office, got wallpaper, falling off the walls.
Yeah.
Fix it a little bit and then plug a tenant in it. And really the fundamentals of that are, when you're buying a property, the most a property is ever going to be worth is when it's leased with a long-term triple net lease on it, at least in my world. So when it's got that long-term lease on it, typically 10 to 15 years, some brokers try to say that, a long-term lease in today's market is 5 years. A long-term lease is still 10 to 15 years. Isn't going to change. There's folks that would say, well, no one, none of the big guys are doing 10 or 15 year leases anymore. It's like Dollar General's still doing them. There's a lot of big, folks doing 10 and 15 year leases. So a long-term lease, because then you can sell it on a cap rate basis, right? A vacant building, you can't sell on a cap rate basis. So you're selling on a per square foot basis. And then there's an arbitrage in there. So you get compensated as the investor to do the work because you bought it vacant, where you're carrying the note by yourself. You're doing the work. You have to raise enough capital or invest enough capital, go get a big enough bank loan to where you can carry the debt, do the work, pay the leasing commissions, and sit out there with a vacant building for 6 months to a year. And then you get a tenant in there. And then, once you back it out on a cap rate, your building is worth more, hopefully.
Right.
Obviously, that's kind of the value add strategy for industrial, and that's what we focus a lot on.
Okay. And what type of, you said between 5 and I think you said 5 and 15,000 square foot. What type of tenant base are you looking for? And what are you typically seeing? What types of businesses?
Yeah. You're 5 to 50,000, 50.
Okay. Yeah.
There's really not that big of a difference in the type of tenant, just as size and revenue. Your 5 to 50,000 square foot user is typically a home services based business, some sort of manufacturing or supply or distribution company. We're not targeting the concrete tilt up Amazons or Home Depots or big distribution, FedEx, things like that. We're targeting middle market companies that are lower middle market to middle market for the size of the building. On the small side, you've got Joe Bob's HVAC, plumbing business, car tinting, small general contractor. One of my favorite tenants that I've found that went actually in the building I was talking about earlier where we had to go to the prison is a bread distribution company. And they just I didn't need, when you show up to Walmart or, your local grocery store, that bread looks fresh every day. And you're like, where did this come from? How do they keep this so fresh? It's because there's a company that's localized that distributes all that bread every morning. They take it out, they go in and they stock it on the shelves before the store opens, which is pretty fascinating to me. Yeah. Your mid-sized tenants, your 25,000 square foot, you get kind of more into the food and equipment kind of businesses. So, we've got a client that does insulation, and they're a regional company, and they're in 30,000 square feet. We've got 75,000 square foot tenant, a little bigger, but they're in the building materials space. And so it really ranges, but it's these, what's her name? Corey Sanchez, maybe big,
Cody
Instagram.
Sanchez. Yeah.
Cody Sanchez. The boring businesses that cash flow is typically what's going in this real estate. So, multi is like the quote unquote sexy child of commercial real estate, but it's like, man, get me a metal building that's got a couple roll up doors and a good old boy that's got, an HVAC business. I guarantee you he's paying his rent.
Yeah.
And when he moves out, all you're going to have to do is take a leaf blower and a new can of paint out there, and like you're going to be good. There's not a lot more to it than that.
Yeah. Well, and what are some of the improvements and things that y'all are doing to them? You mentioned the value add, and obviously maybe some parking lot improvements and stuff. But aside, and I think you mentioned the offices as well. But what all are you doing to kind of improve those properties?
Yeah, great question. So typically, you're going to have to go in and first things we look at are foundation, structure, roof, kind of parking, fence area. And those are like your big main issues, right? If you're a distributor and your roof is leaking, well, you cannot distribute that product.
Right.
So you got to that if the building's going to collapse, got to make sure that that's fixed. Got to make sure that people can park, that you can get your trucks in and out of the properties. So access is really important. And then a lot of it comes down to aesthetics. It's okay, hey, we got to paint this, we got to make this look nice, we got to fix, how this looks, kind of the paint on the outside. Everybody, for some reason, paints these warehouses tan. And it's like, tan is not an attractive color. Like, can we learn from HGTV, paint it white, put a little blue or black stripe on it, and to offset it, and it's going to look beautiful. And then another thing and typically this is where a lot of people, if they have vision, can make the most money, is if you buy a warehouse, let's say a warehouse is 10,000 square feet. Well, most 10,000 square foot users need about 2,000 square feet of office and 8,000 square feet of warehouse. So it's a 20-80 breakdown. Well, most users who have owned the building for a long time and then vacated, they just kept building offices as their company grew. And so you'll find these warehouses that are 50, 60, 70, 80% office and 10, 20, 30% warehouse. Well, if you can go in there and at first, when I first started in real estate, I didn't understand this, that most of these metal warehouses are kind of like Legos. So they've got like a wrought iron red bar, and every 10 or 15 or 25 feet, there's another one, and then another one. So it's like Lego on the outside, and you can just kind of build the modular piece on the inside.
Yeah.
And so when you think about it like that, you're like, wait, I can tear out all of this office and none of it's structural. And then it's like, oh, I can tear out most of this office, leave the bathroom, because that's where a lot of the cost is going to be on the renovation, just like in your house or anything else, and leave a few offices in there and make it mostly warehouse again. When you can do that, there's a great value add, because most people don't want to, like a user doesn't want to come in and tear out the office. They just want to move into the business, move in and operate their business. Another thing you can do is work through kind of the parking lot situation. I know that's kind of weird to say, but if it's got yard space. So another building we just bought, didn't have any yard space. Well, we went next door, and the owner leased a half an acre from the owner behind him. And now we've got a half an acre within 3 blocks of downtown for industrial space. It's like, that's a great, now we can park, someone could have their truck, your employees could park, you could have your trucks parked there, and you have access to the property, right? Like you have overflow for outdoor storage, things like that. And then the last way that you can kind of add value that I see is fixing the title issues, kind of doing kind of the paperwork stuff, which isn't always great. If there's a lot of properties that, like I was mentioning, they're warehouses, but maybe they were zoned like L1, they're light industrial 1, and that's got a limited number of uses. Maybe that's only for services companies. Well, if you can get it rezoned to L2, L3, L4, you could have a concrete company move in there. You could have a heavier user move in there. And so typically we don't a lot of the times play in the rezoning game, but there are a lot of my clients that do play in the rezoning game. And just by moving some paper, they can add hundreds of thousands of dollars of value to the property.
Yeah, that makes sense. And what about like some of the due diligence and stuff that are involved with some of the industrial? What are some considerations that you need to take when you're purchasing one?
Yeah, first and foremost is a geotech. Second is a survey.
Okay.
So your geotechnical is going to be, kind of your environmental. Is there something that is in the history of the property that it has made it contaminated? Are there gas tanks below the ground? Is there a septic tank that has overflown or not been sealed? Is it on city, is it on city water? Is it on a well? Things like that can really affect it because, think about if you're a user, let's say, you're a pressure washing company and you need that water every day, like your well is going to be, you need that well to be operating at full capacity, I guess is what I'm trying to say. Versus like city water, it doesn't matter capacity because that water is always going to be there. It's always coming in. And then second is the survey, making sure that your building's actually built on the property. You'd be shocked of like how many buildings are not like properly built on the property and the setbacks aren't right. And then you get into, if you try to redevelop it, and this is why people don't like the value add redevelopment game, is if you try to update something and it's non-conforming, by zoning, you have to bring everything up to conforming. So when, we run into that a lot when we're trying to value properties is, I'll walk through and be like, okay, this property, and other brokers too will be like, okay, this property is worth, call it $50 a square foot. Well, I don't realize that the electrical isn't up to code. Well, electrical replacement is a huge expense in industrial buildings. And that could be, $5 to $10 a square foot, depending on what has to be replaced. So your building could, the building itself could be worth $50 a square foot if it had the right electrical. And the seller, a seller of a building doesn't want to hear that. They don't want to hear, oh, I'm only going to get, 80% of list price because the electrical's not right. Like that doesn't make any sense to them because they're like, there's no way electrical could be that expensive. Then you sit on the buyer side and you're like, man, if I don't get this price reduction, if I don't get it at, $40 a foot, there's no way I could do this deal because it's going to cost, all these rehab costs. And so it's the typical bid ask spread. And there's a lot of, in the industrial space, what I found is there's a lot of arbitrage opportunities. So what I mean by that is, let's say you listed a property and you said, hey, this property is 50,000 square feet. And it's actually 30,000 square feet on the bottom floor and 20,000 square feet of like mezzanine space. Well, people would say, yeah, that's 50,000 square feet. Well, technically on the valuation of this building, it's 30,000 square feet per like real estate law. And so when you offer, you're not offering on 50,000 square feet. When you value the building, if you value it on 50,000 square feet, you're going to be wrong. And so there's a lot, like the industrial world, there's weird things like that because industrial users are niche and they're weird, right? Like for the guy that distributes bread or the guy that distributes meat, he's got to have like certain coolers, right? And the next user isn't going to need those. So you have to find, and you kind of got to dial in on like, okay, this is a little bit off here. Why is this property sat on the market? I think a building my buddy had for, listed for almost 2 or 3 years. Awesome thing. Only building with massive clear heights, only building with access, things like that. But what was weird about it is the previous owner had leased it out for a number of years for like 15,000 square feet. So there was 70,000 square feet in it and people didn't want to be in there. And so someone came along and they were like, what they were looking for the whole time, and it took them 2 years to find it, is an owner who would buy the building, occupy it, and be okay with sharing space. It's like, you didn't think that would have to be that hard, right? Like sharing is caring, Right. And we learned, or it's like just share the space. But business owners are specific, especially if you're going to run, your own company. As we all know, we've got, very eclectic characters who run those, and they want it very specifically. Typically type A people want it to be this way or the highway. And if you're going to spend $4 or $5 million on a building, then hey, it makes sense.
Yeah, for sure. That's interesting. And what are some other considerations or things that maybe investors would need to consider when it comes to buying industrial?
Yeah. First and foremost, I would get with I would call 5 to 10 contractors in your city, and I would get with 2 or 3 brokers and just ask them to send you some land listings, and then get it priced out. I would ask a contractor to price out a 5, a 10, a 15, and a 20,000 square foot building. And, some contractors are going to say, oh, there's no way, you got to pay me $30,000 up front for me to price this building out. It's like, yeah, if you get really specific, but you can also, take them to lunch, get a ballpark idea of where you're at. Because what you want to establish is your replacement cost. Because
Okay.
one thing is for certain is construction prices aren't coming down. When's the last time you met a business owner who's like, oh yeah, we're bringing our prices back down to what they were back in the day?
Right.
You've never heard, Walmart isn't going to be like, oh, hey, we're going back to the 5 and dime model. The dollar store isn't going back from $1.25. They're like, we're here at $1.25. If the dollar store is going up in prices, we've got some issues in the world.
Right.
So you got to establish what is your replacement cost. And then, because your replacement cost is kind of your par, right? Because why would I ever go buy an older building that is going to have a bunch of problems if I could build a brand new building for cheaper, right? The answer is you would. If you could go to, the best area of your town, the part of town that you wanted to live in, you could buy a lot and build your dream house for cheaper than you could buy a current house. You would do it every single time.
For sure.
It would make no sense for you not to. The reality is you can't do that. You can't go buy, if you want it, first off, it's like, can I go buy a lot in the neighborhood that I want to? Likely not. Can I go build a house for what I can buy one for? Likely not. And, especially, is it going to have the look that I want, the aesthetic that I want, all of these things. And so once you establish your you establish your replacement cost, you can go back and start to work from there. So then you can say, okay, number 1 rule of real estate, number 2 rule of real estate, number 3 rule of real estate is location, location, location.
Yeah.
So send me, let's identify the area that where is the market growing in our area? And then what are the rents in those areas? And so do your rents justify a return? And I'm not talking 2022 a multifamily cap rate. I'm talking, can you get an actual yield with 7% interest rates? Can you get a 9, a 10, or 11 cap on your development? Because you have to be compensated for your risk. That's why developers make the most money. It's because they're compensated for their risk. And so if you could go build, like in Birmingham, for example, it costs $120 a foot to $180 a foot to build brand new industrial. And, verify that by your contractor. But if you're going to do that, that means to get a 10% yield, you'd have to get $12 triple net. It's like, that isn't happening in Birmingham, anywhere. And so consequently, when you see, let's say, one of the things we did is a sale leaseback. Sale leaseback is where a business owner typically owns their business and their real estate, and to create a liquidity event, maybe for more capital, maybe for just to have cash on hand, maybe to grow their business, they want to sell their real estate. And they can capitalize that by signing a long-term lease, 10 to 15 years, and selling that building on a cap rate basis. Deal I saw yesterday, rural part of Georgia. Definitely not a market that's getting $14, $15, $16 triple net rents. The guy said, oh yeah, the building is this, and I'm selling it at an 8.5 cap. 8.5 cap is an attractive cap rate. Well, why is it such an attractive cap rate? It's because the rents are way above market. So if the tenant fails and the tenant blows out, you're never going to be able to replace that rent. So now you're going to have a building that you way overpaid for. And in that scenario, you have to look at that deal and you say, man, I couldn't even buy this deal at a 10, 11, or a 12 cap, because there's no way I could, you have to back it down to the replacement costs of the building, right?
Yeah.
You see a lot of medical or of the dispensaries right now like this. If you go online and you try to buy like a dispensary sale leaseback, they'll be like 12 to 14 cap, because they're paying these super high rates because no one will let these medical marijuana dispensaries or growers go in their space, because they just don't believe they're going to be there long term. Well, if you buy it on a 12 cap at, rent, I saw one in Michigan, rents were $60 a square foot for industrial. It's like, you're just never going to get that.
Yeah, no, that's a good point. Yeah.
So, yeah.
Yeah, it's a good point. To buy something, especially if you're buying it as an investor to hold, and you've got a tenant that you just, there's a unique circumstance in there, like a dispensary or somebody who, unless you're replacing them with another one and another one that's willing to, pay that same amount, it's kind of the value's artificially blown up, and you just won't be able to find that same type of tenant again. So.
Yeah. Another thing that I think about a lot is just, where do you want to be? There's industrial pockets, and industrial land is going out of style. People don't like it. People don't want, they want homes. They want nice lots. They want wooded land. They don't want industrial building. So if you can find industrial land, you can build a building on it. It's typically a good idea. You just have to make sure that the rents justify it. Right now, there's not a lot of rents that justify building new industrial. Even, high interest rates, low interest rates. The people who are winning right now are the people who can get, who are vertically integrated, who are paying all cash for a site, building the building up, building the building all cash, and then leasing it out. It's like, they'll refinance and get their money out when interest rates come back down, whenever that will be. And those folks are going to win in the long term.
Yeah, for sure. Well, Sam, where can folks find out more about you if they want to connect with you, if they want to utilize your brokerage service, if they want to be possibly involved in any of your investments?
Yeah, you can go online to LinkedIn and look me up there, or you can just give me a call, 404-291-4684. You can shoot me an email. I'll give you my personal email, just sam.zoldock@colliers.com.
Great. All right. Sounds good, Sam. Well, this has been really cool. It's always interesting to kind of peer in the world of, in this case, industrial, and also just, kind of take that drill down to the different cities in Alabama and, kind of what's going on there. So thank you so much, Sam. I've got two other questions for you if you have just another minute or so that I ask every guest. One of them is just, what advice you might give somebody who's just starting out in their investment journey.
Yeah. Is this to a new syndicator or someone just looking to invest in real estate in general?
I think just somebody in general that's looking to invest.
Yeah. Get as much advice and learn as much as you can. The number one thing I see people doing is, hey, my friend gave me this awesome opportunity to invest in his multifamily deal or his industrial deal. Like, they feel really welcomed in. And they have no real context. I get messages from people all the time. Man, I invested in this deal and we're not cash flowing because X, Y, Z. It's like, well, did you have anybody double check Did you underwrite it yourself? Did you actually do you understand how the revenue minus expenses equals net profit?
Right.
And they're like, no. It's like, okay, well, you have to educate yourself. Investing is such a powerful weapon, right? It can be a good weapon. It can be a sword, and you can conquer the beast. You can cut the head off of the dragon, and you can succeed, and you can look really conquerors. It can also be just poison to you, right? And so, if you don't educate yourself, if you don't get opinions, there's a proverb in the Bible that talks about how you succeed when you have a council of many advisors around you. And I say back to that a lot about how don't be nervous to share. There's enough to go around. If someone sends you an investment deck, send that out to some of your broker friends. Network with some people. Network with other seasoned investors, and say, "Hey, I got this. Would you invest in this?" Because if they would invest in it, potentially it's good for you to invest. And don't go bet the farm on one single investment, right? Some people, just want to put their money everywhere, all their money in one spot. It's like, why don't you spread that out a little bit? Even Warren Buffett is diversified.
Right. Exactly. What about a book recommendation? It doesn't have to be real estate related, but it certainly can be, but just something you've read that's been impactful.
Yeah. Man, there's so many that come to mind. As of recently, there's a book. There's a book by a Harvard professor, and I'll send you the book, and you can include it in the show notes.
Okay.
But essentially, the book, it defines or talks about life purpose, and talks about how we define we don't have definitions of success. So in everything in life, typically you get to set your own goals, right? You work a sales job. You say, "Hey boss, here's the quota I want to hit." He says, "Hey, I think you can do better than that." And you work to some mutual agreement. And in this book, this professor talks about how most of the world is unhappy because they don't set, their own definition of success. They don't say, "Hey, for me, success is loving my family and making sure we always have food and a roof over our head." They just go through life and say, "Hey, success is having the nice car, the big house, the country club membership, lots of money in my bank account, going on vacation all the time." It's like, that's great, but is that really what you want? Have you thought through that? And so that book processes a lot about how you can ask yourself some questions and come up with your own definition of success that you can feel confident in.
Yeah, it sounds like a good one. All right, sounds good. Yeah, if you send me that, I'll make sure that we've included in the show notes. But
for sure,
Sam, yeah, this has been good, man. I appreciate it. And thank you so much for being on the Wealth Flow.
Yes, thanks for having me.
Absolutely.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.